Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited that you could join. Our objective here is to try to help you have a more successful retirement. We do that by answering your questions, so please send your questions in. You can really send them in at any time, and thank you for those that sent questions in this week. But you can send them in now. We try to answer them live. Send them to the email address here, the Ask Tom email address, or just put it in the chat box here, and we'll try to respond to that also. So go ahead and do that. We'll really be excited to try to help you as far as that goes. The genesis of this particular channel was really as an educational portal, a communication portal to our existing clients. We believe that the more our clients know about how to manage assets and how to do an effective retirement plan and Roth conversions and tax planning and all these different areas, the better it is for them, the better they'll do, and the better they do, the better we do. So this is how this got started. Obviously, there's a lot of non-clients might be, watching the show now, what have you too. So you feel free to subscribe to the channel if you'd like. You can hit the bell button and go ahead and get notified when we put something new on there and kind of join along with what the clients are learning here. And I think you'll see kind of the power of what we're talking about. And of course, if you want to meet with us just on an individual basis, you can just hit the book appointment button at the top of our webpage. There's a link to the webpage here on the channel. And you can sit down and talk to Ethan and I for 30 minutes on a phone call or a video call. And, maybe you have some custom questions that are personal to you that you'd like to ask. So we can do that then. So looking forward to today. Very excited. We already have some great questions that came in. A lot of questions about the markets and some volatility that's been happening recently. So we'll cover those and such too. So I do always like to start off the show with a conversation about kind of what I saw happening in the market this week. I'm going to have Ethan join me today too, because Ethan's always asking me questions about the market. So some of the things that maybe you'd like to hear answers to also. So what we see here so far, the S&P 500 chart, this is for the year up until today. The blue line there shows kind of the 200-day moving average, and the red line I've just left in there is kind of the top trend line attaching a couple of the major points as far as that goes. So you can see what's happened this week. The market's down. And a big chunk of that down happened because of the core and top line inflation results that came out on Tuesday. So this is a consumer price index. It's a basket of goods that they look at. And in this particular case, we're looking at, August and August of last year. How much did it go up? And, it went up 8.3%. And the expectations were that it would go up 8.1%. It's not a big difference, but it was a big difference to the market. And there's some other pieces in here that are important also. But I guess the one thing that we can hang our hat on at the moment is it wasn't higher than where it was, back in July. And you can see that actually June reported in July. But peak inflation was at 9.1%. So, we're going the right direction. It's just going so slow that it makes the market really nervous about what the Federal Reserve is going to have to do. And the Federal Reserve, this is called top-line inflation. And there's another thing called core inflation, which is what this chart shows here. Core inflation, they take out food and energy. And the reason they do that is because food and energy tend to be very volatile. Food prices are going up quite a bit. Gas prices are coming down a bunch. And that, those are all over the place. And the Federal Reserve often talks about core inflation because they feel like when they're raising rates, they have more impact on these core areas. And there's all kinds of pieces in here. Rents are one of the big drivers right now, but you've got all service areas, restaurants, alcohol and tobacco sales, and all these different things. Now, if you look at that chart shows something interesting because it shows a 6.3% core inflation as of August, so this August versus last August in 2021. And the important thing there is that we actually peaked out here in March, and we've been coming down month after month after month after month. And so that was fantastic because as long as core inflation is going down, the Federal Reserve maybe could lighten up a little, right? But then it jumped. As a matter of fact, it was supposed to be at around 5.7, 5.68, depending on who you listen to, but it jumped all the way up to 6.3%. And I know that seems like a small amount, but in the world of inflation, that's actually kind of a big deal. And of course, the direction is a big deal too.
So how does that affect, next week the Fed's meeting, they're going to announce rates. So how does core inflation going up affect, their decision-making process?
Well, when this report came out, the market was betting on a half a point or a three-quarter point increase, right? And going back and forth, starting to get more and more towards a three-quarter point increase. But then when this report came out, all of a sudden now there's a segment of the market. Right when this report came out, it was about a third of the betting was on a 1% increase, which is a big number, and three-quarters was the other two-thirds. And so, and that's where, the more they raise rates, the more it should help inflation, which is good. So there's a segment of the market that sees that as good. They like it. They want more rates and higher. They think we should go for, I read an article talking about they should go for 2% on, next Wednesday. It's like, okay, just to get it over with and to really hammer things down. But the real concern for the market is there's a lot of things slowing down, right? And we're seeing housing start slowing down. We're seeing some companies. We'll talk about Federal Express later in the show because that was one of the questions that came up, but it dropped a bunch today, 23%, because they were showing that there's sort of a global slowdown in their business. And so when you raise rates, you don't see the full impact for 6 months. And so it's kind of a dangerous game. And they're raising rates based on some thought process for where this economy is going to be in March of next year. And that's very, very difficult. And the other thing is that people worry about is the Federal Reserve has just been so wrong, right? The September meeting of last year, the Federal Reserve put out their statement. Their expectation was that they would not raise rates at all until the beginning of 2023. Just 1 year ago, they said that inflation was transitory, right? Temporary, and that they didn't need to raise rates in 2022. Wow.
Yeah.
Way off. I mean, we were raising rates at near record paces, 2 3/4 point increases. Now maybe another 3/4, maybe even a 1%. And so they can get carried away. And historically, they have gotten carried away because it's such a blunt instrument that has this huge lag to see what's going to happen. And so that makes the market nervous. Whereas inflation was coming down here and just core inflation was coming down and things were happening and moving along, the market would probably be really happy. And we were on a nice roll for 4 days in a row prior to the release of this inflation report. Because, if the trend is down, then the Fed is eventually going to be able to kind of back off. But when the trend goes up, it just makes it more likely the Fed's going to get more aggressive and have more chance for a mistake and create this hard landing with companies' earnings being wrapped up in that hard landing, right? And that's one of the big things. So, yeah, it is interesting to see what's going on, and we talk a lot about the Fed because it's the big driver, really, because we're talking a lot about inflation as far as that goes. And so, what happened this week, at least from my perspective, that was kind of important, and just to let everybody know, over a couple week period, we reduced our stock market exposure. We got rid of about 18% on average of our stock market exposure. So if you had a 100% portfolio, you were down to 80%, stock, 82%. If you have a 60% portfolio, you were a little bit below 50%, 48 or something like that. And it's not even, it goes all the way across. And just so everybody knows, when we reduce positions, we don't worry too much about anything to do with the IRAs. We do those and keep them right on the model because there's no taxes. The taxable accounts is totally different, and so we don't want to take big gains. And so we've been selling things, that are in our models that have less than a $10,000 gain. And so everybody's got different experience. Some people have huge gains in the same position somebody else has a loss in, just because of when they became a client or when that money came in, as far as that goes. So, and then. As of Wednesday, the day after that big drop that we had from CPI, we actually made a much bigger move. We moved another 26%. We essentially got a sell trigger on our S&P 500 positions, and again, we sold what we could sell without creating big gains, and it was a really big move for us because we have a lot of money in that. And it worked out so far. I mean, as we sit right now, the S&P 500 is about 3.2% below where we sold. So that looks good, but the trick is getting back in.
Yep.
So we'll see. We do have a process. We do have ideas on when this is going to happen. But at the moment, we're just moving money to T-bills and ultra short-term bonds as a holding place. just to protect, because that's a fairly significant, that 3,900 was a pretty good support level, and we basically gap opened right through it this morning. So again, I'm glad that we have what we have on the sidelines kind of out of play here, because the next support level isn't too far away. It's about 2-3%, about 3,700 on the S&P 500. But really, the next support level past that is what worries me. I have to go back to a 3-year chart here, and you can see, these aren't randomly drawn. These are all concerning volume and volume profiles and all kinds of things that I won't bore you with. But that line is the next significant support. There's a pretty big gap, and that's about a 13% drop from the previous support. So again, I'd rather have some money on the sidelines in case that does happen, because here's the one thing I do see in all of this is that we have a chance here if the market does fall, and we have money in treasuries and ultra short-term bonds that don't fall, essentially, or much. If they do, they're kind of stable, to be able to take that and buy back in at a lower point, right? We'll see. I mean, things could turn around. The one big event that's happening next week that I think is pretty interesting is just the whole, the CPI meeting. Right? So, I'm sorry, the Federal Reserve meeting that are going to be discussing what to do about CPI. And so, what do they do with rates? If they go 3/4 point, right, there is basically a third of the market or so that thinks it's going to go to 1%. So if they go 3/4, I think the market actually moves up on 3/4. If they go to 1%, it goes down probably because, again, 2/3 thinks 3/4. And so, because the market's trying to factor in these different increases and such that are happening. And then in the question and answer periods, when Jay Powell gets out there, the last one that he did was in July, because they don't do one in August. The market went up and up and up, and we had a really strong run because it interpreted a few of the things that he said, as positive. So that's why I'm going to kind of hang on to, what we have still exposed to the market to see what the results are, how the market responds to that meeting as far as that goes, because we do have triggers on a majority of our assets as far as that goes. So we'll wait and see what happens then, because you can get a pivot that the Fed causes. The problem with these pivots that move up, the Fed doesn't want the market to go up, right? And so then they, once the market moved up after that July meeting, they spent a lot of time, including this big Jackson Hole speech, pounding that they were going to just essentially kill everything in sight if they had to, in order to make the inflation go down. And they were warning stock market participants. And the reason they need the stock market to go down is because we tend to spend more when our accounts are worth more. And they want us to spend less and help out inflation. So part of their inflation fight isn't just raising rates, it's also talking. It's what we call jawboning, right? And so be very interesting. It's a lot harder, actually, when he does the Q&A session. When they did Jackson Hole, 8 minutes, no Q&A. He could stick to a script and hammered the market. It worked. It took out almost $1 trillion, $998 billion that day in that 8-minute speech off the market here in the U.S. But he's going to have a question and answer session where they get to ask, and sometimes that's where some of the other softer comments come up. So anyway, that's what's happening. We've got a defensive position. This isn't something we want to do. It's just something we feel is important to do here because the downside risk is higher than the upside potential, in our opinion, at this point. But
so how would you get more defensive, or say the market breaks that to where it's that 3,700 and it breaks through that 3,700?
Right.
What's the next step after that?
Well, certainly. It's something we're working on right now. We'll either move more money into the T-bills and ultra short-term bonds, or we may move some money into the inverse positions, like ProShares short S&P 500. It goes the opposite direction for the most part as the S&P 500. And the reason we look at those inverse positions is not so much to make money per se, is because we have positions that clients have that they can't sell without a big gain. So we sold Microsoft and Apple for most people a while ago. It was good. It was probably down 5-6% since we sold, and so it was a good thing to be in T-bills for that. But we didn't do it for everybody because some people have huge gains, $100,000 or whatever it might be. And so the way to kind of hedge for those people is to take a portion of our portfolios and put it in something that goes the opposite direction. So that way we don't have to sell, let's say Apple, which I like, generally speaking, that has a $100,000 gain. We can put that into this inverse position that goes the opposite direction of the market. So if Apple does drop, they'll have some offset, right? It's a tough one. Those are the real issues that we're looking at here. So, one of those two things will happen because, we only have a few positions even left in our overall models as far as that goes. So I hope things turn around. I hope things take off. I hope the Federal Reserve, gets to a point where they can start letting us have a higher market. But in the interim, I think that's the strategy. So. All right, so that's our summary for the week. Thank you so much for listening to this, and hopefully I'll be able to, talk to you again next week about this also. All right, so let's get to the first question here within the show.
So the first question is kind of a common problem a lot of our clients are having is, what do I do with a highly appreciated investment that isn't performing very well in this market? The market's down, but it's performing worse than the market.
Yeah. So we've got some of that within our practice. People that have individual stocks, they work at a company here, a tech company, and so they're doing worse than the market, but they still have huge gains. We have some positions that we have. Even the S&P 500. I've got clients that have doubled their money in the Vanguard S&P 500. ETF VOO. They bought it back in 2011 or something. And one thing about ETFs is they're super efficient. They don't pay out a lot of capital gains. The bad thing is that you end up with a lot of unrealized gains that make it hard to make a change. So it's actually, there's a bit of math involved, and I'll give you some very simplified, believe me, for those of you that are really good at math, you're probably going to cringe at this, to be honest. But I have $1 million, let's say, and I've doubled my money. I put in $500,000. I've got a $500,000 gain. It's not doing well, right? And maybe it was worth a lot more before, but I'm tempted to sell it just because it's doing so much worse than the market. But I have a $500,000 gain, and that can create all kinds of problems in terms of what tax bracket I'm going to get into. But the way it works for capital gains is sort of a flat tax. The brackets are pretty wide. I'm probably going to pay 15 or 20%, right? Probably closer to 20% on a $500,000 gain, but nonetheless. Plus, if you have a state that taxes capital gains, like we do here in California, they just consider it ordinary income. So you can get all the way up into a 13% bracket here in California without too much effort. So let's just say I have to pay 30% in tax. So I have $500,000 gain, 30% in tax. I have to pay $150,000 in tax, right? And so, that's a big difference. Right now, I had $1 million. I sold it. I have to pay $150,000 in tax. I now have $850,000.
Yep.
Right. So I have to think about that and say, okay, that's down 15% guaranteed if I sell it. Now, if I sell it and it actually drops 30%, that was perfect. I'm glad I sold it because I'm down 15. Right. Yep. Again, you dropped some because you still held, potentially something, but let's say you sold it all. And having said that, how many things drop 15%? So when we look at, say, the Vanguard S&P 500 index, and you'd say, okay, in order for me to break even here, this has to drop at least 15%. I'd hold on to it. Yeah. Because that's not very common. I'm looking at NVIDIA or some other stock, right, that has the potential to drop or jump 15% in like a week. Well, okay, maybe, but I'd have to really have some conviction that this might happen, right? And that's what makes it so difficult. It's why it's probably better in a lot of cases like that to buy and hold. So you'd want to do the calculation. How much is the gain? If I lost 30% of that gain, just again, using an easy number, it might be less, but then how much would my holding have to drop before I'd get to break even? So if it has to drop 2 or 3%, okay, I might do that, right? Because that probably happens or could happen. You still have to get back into something in order for that to work, which isn't easy. But if it, is going to drop a significant amount based on the tax payments, okay, so that's the first part. You need to kind of calculate, what you're going to lose, what your break-even point's going to be, and then what is the likelihood for this particular security to move that much, right? All right, so there's that. The other option is to kind of hedge the position. So let's say I have $1 million in Apple. I paid $500,000 for it. I don't want to sell it. Yes, it could drop 15%, but I don't want to pay the tax. And so what I could do is I could go buy, an inverse position, like the ProShares S&P 500 inverse. And actually, if it's Apple, I might want to buy the ProShares NASDAQ 100 inverse, which Apple's a part of. They call that the QQQ, and this goes the opposite direction of that. Not perfectly, and these are not vehicles for the faint of heart. They do move pretty well evenly with these other pieces, but the object would be that if I lose 10% in Apple, if I can make 10% in something else, at least I've neutralized my potential loss without having to sell Apple, and I don't have to take the gain. The risk is the market goes flying up and I'm making nothing, because I'm making money on Apple and losing money on the inverse portion. So you literally neutralize. And again, I'm being very generic here. You won't actually neutralize exactly. There'll be some discrepancy between Apple and QQQs or whatever, right? But in general, that's a thing I've seen happening quite a bit recently. Matter of fact, there's been a lot of money pouring into these inverse funds. And I think that's a way, if you have a highly appreciated asset, at least to look at as far as that goes. And again, not everybody has that extra money sitting over there someplace that they want to do this with. But
do people ever say, hey, I can't sell everything, but let's sell 10% or 20% of this holding?
That's
and so you sort of trim it, but you don't get rid of it completely.
Yeah, and especially if you're looking at, your tax brackets and the capital gains levels. So, hey, I can stay within this 15% level if I only sell 10%, so that's going to save me some taxes. And, yes, exactly right. So kind of paring back a chunk of what you've got in there just to capture some gain, right, while you have it, assuming it does go down some more. So, yeah, that would be the kind of the middle ground between those two. So it's a really good question. It's something that comes up a lot. We see it constantly within our practice, within the holdings that even we have purchased for clients. We see this within the Valley here. Silicon Valley is full of companies like Apple and Google, all of these big NVIDIA and all these companies that have had huge runs in their stock. And if you work there, you're getting a discount, and a lot of times in the way that these programs work, so you can have an even bigger gain as far as that goes. So there's a couple strategies to take a look at on how to try to hedge that. It's not easy, but it's a good problem to have. Yeah, Still a problem. Okay, what's the next question?
So this question came in from a client of ours. We've talked about the stock portion of the portfolio. What are you doing for the bond side of the portfolio?
Yeah, that's a good question. I apologize for not talking more about the bond side of the portfolio because it is a big piece. We have clients that have as much as 80% and 90% in the bonds and only 10 or 20 in the stock. We tend to talk about the stock market all the time just because it's more, there's more motion there and there's more happening as far as that goes. But overall, the bond market this year has been pretty brutal compared to previous years. And I think the last show we had a question about kind of the parachutes, and the bond portion is supposed to be a parachute. And on that last show, I think at that time the total stock market index with Vanguard was down about 16-17%, and the total bond market index with Vanguard was down about 12%. Right, so that's a pretty big number for the bond market. And usually you'd like to see it going up when rates are when the stock market's going down. And that's not happening right now because bonds go the opposite direction of interest rates. And so when they're raising rates like they're doing now and these big numbers they're talking about, the bond market starts to come down. So we've done the same thing on the bond side that we've done on the stock side. We've reduced our exposure to the overall bond market and put the money in T-bills and ultra short-term bonds that are more stable and don't move really that much at all. If anything, they maybe move up a little bit in this type of environment. And so we've reduced about 75 to 90% of our exposure to the bond market, which is more than we've reduced on the stock side, mainly because the people that are heavily into bonds are more conservative than the people that are heavily into our stocks within our practice. And so we tend to, be a bit more cautious there. I wish we would have done something earlier, but you kind of have to hang in there until you start to see more and more degradation to kind of prove where this market might go, because otherwise you get out and it just jumps right back up and you lose by not being in. And we're much more satisfied to be buy and hold, believe me. I know it doesn't seem like that recently, but this is a pretty unique situation. So anyway, to answer the question, we've made changes. We will continue to move out of the bond market if it continues to deteriorate. But bonds will bottom before stocks historically. And so one of the things to keep in mind, when they raise rates, bonds pay more. The problem is when they're raising rates, the value drops faster than the increase in the income. But eventually, when rates stabilize even a little bit, the value of the bonds will stabilize also, and now you're getting paid more, and so you can go from getting paid basically nothing because rates were so low to now getting paid, 3 to 5, 6% or whatever it might be once things stabilize. And so, there will be some opportunities here to come back in and buy bonds, I think, at a good price and a good yield, and then maybe benefit from that. And if the Federal Reserve does have to stop raising rates or even slow down raising rates would be a start, or ultimately maybe start decreasing rates to support the economy that starts to slow down too much. If that happens, then bonds would come up in value as well as pay that higher yield. And so there is some good opportunities here, but in the interim, we have kind of set some of that aside, and we're just, you got to have something to use if the markets do go down farther to come back in at that point in time. So we're doing the same thing on the bond side as we are on the stock side.
So why is renting in retirement so undesirable?
Okay, so this is kind of interesting. We do have a visual on this because this came up actually in one of our strategy sessions. Quite a few of our strategy sessions, this has come up. And so here's a couple different situations. I have an 86-year-old that's trying to decide whether, to rent or to buy, right? And she's currently renting and looking at possibly buying, but she's kind of leaning towards renting, right? And so when I look at her plan and I run her plan with a rent versus a fixed payment, it really is kind of a coin toss, because this chart shows how much rents have come up over the years, right? And you can see the acceleration in the last 12 months, right? A little steeper move there. And but she's 86.
Yep.
So it's not as much. So then I talked to her about, well, what do you like about renting? The number one thing she likes about renting is that she doesn't have to fix anything. She just calls a landlord. And that's the number one thing that she worries about buying, is like, even though her rents could go up, she's worried that she's going to end up with more and more costs to maintain the place, right? The places that she's looking at are a little bit older. Maybe they need a new water heater, or, these types of things. And right now it's just so convenient, right?
Yeah.
Now, we had another case we were working on with a couple that was around 50 years old, and they were currently renters. And their financial plan actually didn't work. And mainly because of this chart. Rents are kind of uncontrollably going up, and you could really get sucked up into a vortex of higher rents when inflation gets really high, like it is now. And so you see the scenario where you can have an uncontrollable cost coming at you, and your income might not be going up as fast as your rent's going up. When we ran their plan with buying a place where they can fix in that payment, right, by buying a 30-year mortgage, and even if we included some type of ever-increasing cost for maintenance, their plan worked. It was the difference. Now, the big difference was age, right?
Yeah.
So 50, looking out to say age 100, 60 years, 50 years, sorry, versus 86, right? So age does factor in. For the most part, you want to own, right? Because the other aspect of this, at least here in California, is appreciation. You're not going to get the appreciation. Your landlord's going to get the depreciation if you're renting. Uh, and so, but not every place gets appreciation. You know, I mean, I've got stories from all over the country where people didn't make that much in their properties, which seems weird to us here because that's not been the case. But so appreciation is not a guarantee. It's sort of a cost aspect that we tend to look at.
Another thing is, if you're younger too, if you have a mortgage, sometime in retirement, that mortgage is going to disappear usually. And that's another expense that kind of disappears. With renting, you never get that relief. It's always going to be there.
Yeah, you can have no payment. You'd have property tax and insurance and maintenance, right?
Yeah.
So you have some outflow, but you could eliminate the entire mortgage. And a majority of our clients have no mortgage in retirement, right? Some still do, and that's okay. But that's a really good point. I mean, you get rid of that. That's a big deal, right? That's kind of cool.
So, you talked about FedEx a little bit earlier. What are your thoughts on the strategy of buying a stock after a large drop, just like FedEx today?
Yeah. Okay. So, again, we have some visuals on this. So, Federal Express last night announced their earnings. They missed their earnings. They gave kind of a warning about what they're seeing on a global basis. They decided to not provide guidance going forward, which that was actually what everybody was doing in 2020 because nobody could figure out what was going on. And so they're doing that, and that was seen as somewhat of a negative. And so we have, a chart of Federal Express here, just, year to date, and look at straight down line, 23% drop, at least as of the time we did this slide. And so the question is, should you buy that, right? Hey, it's down. Good company.
Yeah.
I mean, everybody knows Fed Express. They're probably not going away. Should I be buying here? So I have two hats. One hat is the advisor hat. And as an advisor and a money manager, I can't go in and buy Federal Express because, first of all, kind of the minimum position we'd ever buy is about $5 million. Oftentimes it's more than that. And so it's a huge risk, to the practice and to the clients as a whole to kind of come in and bottom fish on this. It is a little bit scary to me to own any one position that could drop 23%. It's one of the reasons why we use these very widely diversified, ETFs like the S&P 500 and the total stock market index. But my other hat is kind of a personal investor, and so I buy these types of things. And there's a couple of reasons for that. And I buy them in very small quantities, and then I'll kind of accumulate if I like them. And so here's an example of one that, you bought some of this too.
Yeah.
And so this is Target. So Target, that was a 25% drop, eventually became an even bigger drop. You can see that they continued down. And so a couple things I would say is, number one, keep it small, and especially right now, let's go back and look at Federal Express. So if you look at where it is right now, it's probably going lower, right? That wouldn't keep me from buying, a small position right now, but I'd want to accumulate like it did with Target. See that it finally hit a low later. That's super common, and that little bounce right there, they call that a dead cat bounce that happened, after that bottom, and then it came down. So I'd accumulate all the way through there until it started to come back up, and now I'm just letting it sit. And letting it grow.
Yeah, and especially with these kind of bottom fishing strategies, your time horizon is a little bit longer.
Yes.
You're not going to say, I'm looking to make a profit in 6 months. You're saying maybe 3 to 5 years. This is going to be a good buying opportunity for that stock to appreciate.
Exactly. And I have clients that have great long-term outlooks, and they might hang in there with me. But this is more something if somebody called us, and we do get these calls. Hey, can you take a little bit of my IRA and go buy Fed Express or go buy Target? And we do. And so that's not a problem. In terms of as an advisor recommending and moving it into my models, that's a whole different ball game. I don't play that game here. But the question is a good question, is what to do. Now, there is another aspect to this. You really have to kind of believe in the company, right? Because I happen to really think Target is well run, did really well. Most of this drop came, I think, for somewhat temporary issue of having too much inventory, right? I mean, because the market the overall consumer market went from, hey, I'm going to buy everything under the sun and buy TVs and all this, and Target has a bunch of orders in on those because they're running out of them constantly, to, oh my gosh, inflation's really high, I got to buy milk instead. And so they saw a huge shift in the consumer behavior within their stores, and they had to discount some of this, bigger items that they had sitting in inventory. So they kind of got caught in that shift. Well, I just feel like they're going to figure that out and kind of get that going. And I don't know that they're not a terrible place in terms of a high inflationary environment. People are going to look maybe for more bargains at a place like Target, right? So I like the aspect of it. And so Federal Express, if I go back again to that chart, that's another great company, good name recognition. Having said that, they're exposed to the global economy, and actually they're a bellwether for the global economy, which concerns me that they're dropping, because if they're dropping, that's a pretty interesting sign for things moving less around the world, and not just here in the U.S. So do I think that they're going to survive that? Yes. Do I think the global economy is going to V recovery from here and go straight back up? No. Not with what's going on in Europe, especially. And so you'd have to have some patience here, but it's not a bad buy. Accumulate. Here's another example, though, where I would be cautious. So this is Metastock. And so you can see this was earlier in the year. It had its big drop, and that was about a 40% drop. As a bottom fishing technique here for Metastock, you wouldn't have done too well yet. Maybe that 3 to 5 year period still works out. But Metastock is going through a metamorphosis from, Facebook to this, metaverse concept. And if it works and, the visionary scenario plays out, you'll be very happy you own that stock. If it doesn't work, it could go a lot lower, because basically their whole business model is starting to deteriorate for a variety of reasons. So that's not something I would play with, just because I have to have enough conviction. Matter of fact, my wife and I, and here's something I'll give you, when we buy a stock, we have to feel like if it drops more, we want more. We have to have conviction. And because, we'll continue to accumulate because we have that 3, 5, 10-year outlook. And so you have to have conviction. I don't have conviction in this. So I haven't purchased it because I'm worried about, it's too fuzzy to me as to where they're going. I have conviction in Target. And so we bought that. So, anyway, that's another aspect of buying on these dips is you've got, now there's traders that aren't looking for 3 to 5 years. They're looking for 3 to 5 tick marks on the
minutes.
Minutes or days and so there are some plays you can play here. For example, that dead cat bounce play, that there's Target, right? So that might just play that bounce. Yeah, and we're out. I made my 5%. I'm going to go find another one.
Yep.
I don't do that, but I appreciate it. I understand, as a matter of fact, it's out there a lot. And so we just have a different outlook, kind of that more of a buy and hold outlook as much as possible. Try to nibble when things are down. We can pull up charts all day of different things with semiconductors and all kinds of areas that we don't currently own in the portfolios because they're kind of coming down so much. But on a personal basis, I have no problem with accumulating pieces of those because I do think there's some opportunities here.
Yeah, and people have had some great home runs. We had a client that bought Apple when it was at the just going through that bankruptcy, and those home runs can really change a retirement.
Oh, it's incredible. I mean, we have some great stories of people that put even small dollar amounts into things at the right times that have turned into huge dollar amounts. I mean, unbelievable numbers. There's some that don't work, right?
Yeah.
But that's kind of the fun part. And I always say this too, keep it small, because if you're right, it'll work, you'll be fine. You don't need to make huge bets. If it works, that'd be great. But if it doesn't, all of a sudden that starts affecting you. So keep it small and make your small bets. And if it works, you'll be happy.
Yeah, because you're not always right, and if a bet goes wrong, you don't want it impacting your outlook.
Yeah. I'll start off with a 1% or 0.5% of my portfolio, very small amounts, and then if it works, I start to add more to it, But if it doesn't, I don't have a lot of exposure. It's just a strategy that I like to use. if I feel like I can be quite brave with very small amounts, personally. So yeah, it's a good question. It's really interesting.
So, what is the difference between a growth and income portfolio?
Growth and income. Okay, so growth is you want to buy it at $10 and it grows to 12, and that's the growth. They call it appreciation. And there's lots of different things you could buy. Stocks are a big one, right? And you want them to appreciate. Income, you might buy it at $10 and you kind of just hope it stays at $10 because really what you're making is the dividend or the interest or something along those lines. And basically you're getting an income production. You can combine those together and create what's called a growth with income portfolio, which might be, say, 60% stocks and 40% income production. And there's all kinds of little caveats to it, but that's essentially what a growth portfolio is versus an income portfolio.
Yeah. So this is a question we've seen more and more of as clients get older. Is my mom is beginning to show signs of dementia. What should I be doing?
This is my 36th year in the business, and so I have clients that have faced dementia. I've faced it with them, with their families. I've had dementia that I've faced in my own family, an extended family. And so it's a really interesting question altogether. What do you do? And there's a couple of just soft subjects that are tough to deal with because I have dealt with this quite a few times. One of the more difficult scenarios to overcome is when the person that you're dealing with, mom, dad, whoever it might be, doesn't feel like they have dementia. People around them, the kids, they're starting to see it. And so they can be kind of like, well, no, I don't really want to do anything different because nothing's changed. And of course, one of the problems with dementia is that, you don't realize it. You forgot something, right? Well, you actually forgot that. You're not going to remember that you forgot it, right? So and so that's where sometimes the outside piece. So that's the first thing is to try to get to a spot with mom in this particular case, if it's not already an issue, of kind of understanding where they are. And so sometimes that's different people chiming in their lives saying, yeah, this is what we've seen, and or a doctor chiming in. So they have to get to she, in this case, has to get to a spot where she realizes, oh, okay, this is happening. And then you start to take action, but you kind of need their participation to, take action. And I wouldn't wait too long for this either, because one of the first things you want to do is to try to get things organized.
Yep.
Living the trust, the power of attorneys, and all these things. They're so much easier to get done when that person is still able to do them than when they're finally to a spot where they're not, right?
Yep.
And I think you were mentioning to me today, too, was just talking about knowing where it is.
Yeah, so this is a conversation I actually had with my parents is, my parents said, hey, we're not always going to be here. And, if something ever happened to us, we wanted you to know where you can find the documents. We don't care if you don't need to read them now. You don't need to do anything with them. You just need to know how to access them, because being able to access them means you can do something with them.
Yeah, exactly. And this is why you need participation. So your parents are already doing it. They're proactive. But I've been involved in situations where the parents aren't being proactive. So that's the first goal in that scenario, is to get participation. And then you're exactly right. Where is everything? What do I do here? And there's a lot of levels of what's going to happen with care and what's going to happen with the money. And so the money part, that's where we come in. We'll usually sit down, do a financial plan, and say, okay, let's make some projections for what care could cost, and let's see what happens to that. The tax planning, what do we do with highly appreciated assets? How do we deal with the home if somebody has to move out of the home eventually into a memory care unit? And so there are a whole bunch of different things like that end up becoming a part of the conversation, and because that's sometimes the cost can be a real big issue, right? And so all of a sudden mom finally gets farther down the road, and especially with dementia and Alzheimer's, it's very difficult for you. Let's say I've got my mother. I'm going to work. My mother's at home. She's living with me. That's good. At least I can watch her some, but I'm not able to watch her all the time. And there's different things that can happen and dangers, and that's why they kind of have these memory care units. But then, of course, they've got a huge cost, and how do you pay for that? And so, it depends on what assets that person has. Medi-Cal is an option if they don't have a lot of assets, but there's a whole host of different things. We could do a whole show
Yeah,
on just
estate
that.
planning and just
Yeah.
getting your set.
Yeah. But first of all, get participation, have clear communication as much as possible, and then, get the documents, identify them, make sure that they're in good order, especially the power of attorney. And if you get to a spot where you are now the power, you've got the power of attorney set up, and you are now in charge of the assets, that might be a good thing to do. But again, it depends on where that person is in their dementia, path.
Yeah, and sometimes it's good to start to, if they're early on and they start to notice the decline, is maybe include whoever you want to have as your power of attorney in those meetings.
Yeah.
So they start to
Yep.
get a lay of the
Yep.
land.
Yeah.
They don't have to make any decisions, but they can just be part of the meeting.
That's right. Yeah. We have lots of meetings with kids that have joined in just to try to learn where things are. And we kind of know where everything is, too, to a large degree, so we can help. Maybe we're one of the main points of contact because, we know about the trust and all these different things. So, okay, that is our show for the day. Really good questions, actually. Lots of things going on with the market, so very exciting to be able to answer some of those. Send in more. We are loving the questions. We get a lot of questions in our strategy sessions, but we'd love to hear from you directly. You can send them into the email address here, anytime. Give us some time to work on them during the week is great. Secondly, of course, subscribe to the channel. We believe education will help you have a more successful retirement. That's what this channel's for. I think we have over 1,000 videos. Start digging through, you'll see some of that power. And then lastly, if you'd like to, you can set up an appointment with Ethan and I. Go to our website, hit the book appointment button, and go ahead and set up a 30-minute phone or video, and we'd be happy to talk to you. So again, thank you very much for joining us again. We will be here again next Friday. We do this every Friday live from 12:15 to 1 o'clock, and you can just come and see, how we do. So thank you very much, and we'll see you next week. Thank you.